What's going on, guys? It's Mike Glaspie here, and today we're going to talk about taxes. Now, we can really break down taxes many different ways, and we can get all the way into the weeds like the tax professionals do. But the concept of this video is to make sure that you understand at least the foundational essence of taxes, to include marginal tax rates, tax brackets, and what you as the average day consumer or the average real estate investor can do to lower your overall tax obligation. Now, this is the class that I usually teach a lot of our agents and a lot of my mentees. So I wanted to make sure that I give the same type of presentation. So this one is actually going to be using a PowerPoint slide, and I'm going to walk through it just like I would any other situation. So without further ado, let's get to it. Taxes. Now, how many of you feel like Andy Dwyer here, right? Parks and Rec is one of my favorite TV shows. But here he says, I have no idea what taxes or how taxes work. At this point, I'm too afraid to ask, right? Most of us now as adults, we know we pay taxes, right? And as investors, we understand that we want to reduce our tax obligation. But that's pretty much the extent of it. We don't really know. And then the second one there says, my daughter asked me what taxes are like. And so she could understand, I went to the kitchen and ate 46% of her cookies. That sounds about right, right? We know that Uncle Sam is in our pockets all the time, and we don't necessarily know why, and we don't know how to get his hand out of our damn pocket. All right, so what we're going to talk about is not only what are taxes, but how do we actually pay them, today? What are marginal tax brackets and how they actually work? The game of taxes, kind of like the Game of Thrones, different tax strategies, pros and cons of having reduced taxes, and then we're just going to summarize it all up. All right. So what are taxes? Straight down to the point. This is literally the definition for taxes, right? But it's involuntary fees. That's the key. Involuntary fees on individuals or corporations enforced by a government entity. So enforced is the second key word, right? In order to finance government activities. All right, guys, so understand that it's involuntary. No matter what you do, these things are mandatory to be paid, to include things like depreciation. Some people still don't really understand that depreciation is a requirement, not an option when it comes to filing your taxes on your home and things of that nature. So it's really important to understand that. The second piece of the puzzle there is that it's in order to finance government activities. And so what are those activities, right? Obviously, some of the main ones, the public transportation systems, the public school systems, emergency responders, military, so forth and so on. And now without getting into all the political debates and everything that's going on, just understand that a lot of the tensions behind the taxes come because the individual, the taxpayer, feels like their money is not being best spent or best utilized, right? Now understanding that the government is using them for their funds, we got to keep that in mind because that's going to play a little trick for us or help us out here in a little bit as we go on with the presentation. All right, so this quote is by a guy named Albert Bushnell Hart. And if any of you are super fans of him, I apologize because I don't know who the hell he is. But this quote really stuck out to me. It says, taxation is the price which civilized communities pay for the opportunity of remaining civilized, right? And how so, right? Through the renovations and the construction of those public roadways, right? Through the maintenance of the police force and the military to protect the peace, right? And again, we're not getting into any of the political debates, but that is the intent behind taxation. Now, obviously, back in the day, taxation without representation meant a hell of a lot and actually caused a full-on war. But the intent and the purpose behind taxes in a civilized society is meant for the betterment of the people, right? And so if we can kind of keep that in mind, but now you can start to understand why some of the wealthy say, yeah, I'll pay more taxes. Yes, absolutely, I'll do my part and I'll pay more taxes, right? Because the intent is a noble intent in theory, right? All right, now how do we pay? Let's get right down to the brass tacks. So as an employee or a W-2, right, if you guys are currently employed, then the taxes are taken out automatically, right? Every time you pull open that paycheck and you see that FICA, Medicare, Medicaid, Bob and Tim, they all took money from you. And it says all these little line items and deductions, and you may have made $2,000, but you're left with $1,200, right? That's because the taxes are typically paid out, right? So that means that your paycheck is net of any taxes as soon as you get it. That means they take it all out. So now at the end of the year, when you're ready to file your taxes, what you're trying to do now is get some of that money back. Okay, that's important to understand because there's too many people that I have heard say or point towards the fact that they think a tax return is like a bonus, like the IRS is paying them. Not at all. It's your money. You've already paid it. You're just trying to strong on the IRS and say, hey, I did what I was supposed to do. I paid more than my fair share. I want some of my money back. That's a W-2, okay? Whereas self-employed or a W-9. Now, this is like any other real estate broker, independent contractor. If you go out and you do photography on the side and get paid that way, so forth and so on, YouTube, whatever the case is, you're a W-9, right? Now, the income, or I'm sorry, the taxes are not taken out automatically. You have to pay them in the end, okay? And so now it depends on how you file, but it's either going to be paid quarterly, right? Once a quarter, or it's going to be paid at the end of the year. The reason that's so important is because there's too many real estate brokers or professionals, wholesalers, flippers, whatever, that'll take this money. And let's say they made $20,000 profit. Well, they think they got $20,000 to spend. Remember the first slide, taxes are involuntary, meaning you don't have a say. You got to pay them, okay? So that $20,000 immediately you can take off a certain percentage to be allocated towards taxes. Now the question is how much? And that's where we get into the next slide. Marginal tax rate, okay? The U.S. Taxing system is a progressive taxing system, which means that the tax rate increases with the more money you make, okay? So the definition of the marginal tax rate is the tax rate paid on the next dollar of income. All right, on the next dollar. So to give you an example, and we're going to get to the actual tax brackets here shortly, and it'll paint a really good picture for you. But if you made $10,000, you're going to be taxed a certain rate up to $10,000. At $10,001, now you've reached the next margin and the tax is now changed. That's what that means, okay? And so the marginal tax rate increases as the income increases, right? It's the progressive tax system. So if you make $100,000, you're going to have more marginal tax rate increases than somebody who made $20,000. All right. So that's the basis. Super important for you guys to understand. So we're actually going to talk about the tax brackets. Now, this tax bracket is for the 2020 taxes, or I'm sorry, 2019 for single filers, right? Now, you obviously are going to have different filings for married couples, filing jointly and filing separately. But this here is just to give you an idea of how it works and to kind of illustrate it. So for your first $10,000, and I'm only using 10,000 to make it round, but obviously you can see it's $0 to $9,875. Those are a lot of numbers. So I'm going to say 10,000 to kind of round it off. For your first $10,000, you're going to be taxed at 10%. Okay. That's your tax rate on $10,000 of taxable income. Now, as soon as you make 10,001, or in this instance, $9,876, right? One more dollar, the next dollar, all the way up to $40,000. So essentially 10,001 all the way up to 40,000. That span is going to be taxed at 12%. Okay. So now you got 10% on the first 10,000, 12% up to 40,000. Well, let's say you made $60,000 this year. So those brackets stay the same. Now, anything over 40,126, the next dollar, up to that 60,000, which is all that you've made, that gets taxed at 22%. Okay. So now you can see how the progressive tax system works. And it's actually this long algorithm, right? That shows like, okay, if you made $163,000, then that means you have to pay 24% on this much, 22 on this much, 12 on this much, so forth and so on. Okay. So the point is, we need as self-employed or real estate investors, wholesalers, flippers, brokers, it doesn't matter. we need to figure out, okay, if we're making all this money, how much do we need to put to the side for taxes, right? A common rule of thumb is many people will put between 30 and 35% of their income to the side for taxes. Now that's good, but let's look at the tax bracket chart here. If we put 35% of every paycheck we got as self-employed individuals to the side for taxes, that means that we would have to have made $351,000 in taxable income in order to actually use that full 35%. Okay. Some people say, nah, man, that's not happening. I'm only going to make 50,000. So I should only do 22%. Hey, to each his own. The way I like to look at it is I'd rather be over prepared. If I don't necessarily think I'm going to make over $500,000 like this chart depicts here, then me, when I'm sitting my taxes to the side, 35% is still reasonable. Now, at the end of the tax year, when I do all of my filing and all of a sudden, instead of paying 35% on all the income, which we know that's not the case, right? Because it's a marginal tax bracket, I end up only paying maybe the first 3 brackets and a portion of the 4th. Well, whatever is left over is now free money. It's actually mine, right? I haven't paid the IRS yet. I'm not asking the IRS for money back. It's actually my money. Now I can view that as a bonus. Okay. So understanding what the tax brackets really are is extremely important, and understand that these brackets are for taxable income. Okay. And so we're now about to get into what the game of taxes mean, right? Taxable income. So how do we get them non-taxable, right? So the game of taxes, right? Tom Wheelwright, he's a rich dad advisor, and he wrote the book Tax-Free Wealth. Yep, Tax-Free Wealth. And I really recommend that you guys go ahead and check it out. The link to the book is down below. So go ahead and definitely download it, read it, because not only will it tell you more about this foundational understanding of taxes, it'll go into real estate very heavily and how you can protect your income there. He says, if you want to know what the government wants you to do, read the tax code. Remember when I told you in the beginning that it's an involuntary fee that the government enforces so that they can use it for government activities. Government activities. So if they want this money so they can use it, right, then they're going to tell you how they want you to structure things, how they want you to do things in their tax code, right? And what they do is they reward those who create more income streams for the government through something called tax incentives. Let me break it down to you. As an independent W-2 earner, I go out and I get a paycheck. I already paid the taxes, but now I'm trying to say, hey, I've made $100,000 after taxes, right? All the taxes are gone. I got $100,000. And I know that I got to pay, based on that tax bracket, let's see, $100,000. I got to pay 24%. I'm going up to 4 tiers here. The entire goal now is to say, how can I get from, let's go back, from that 4th tier there, at least to the 22nd. How can I make $100,000 of taxable income look like $80,000 of taxable income? That's the game. Well, as a person, as just a W-2 employee, there's not much I can write off as a deduction. There's not. I mean, I could do house, right? We can depreciate the house a little bit, and we'll get into that in a little bit. Maybe some charitable events, like some Goodwill donations, but there's not much you can do as a write-off. Obviously, kids and things, that's a different story, but overall, it's not much. But a business owner who's filing taxes, they now get to write off every piece of equipment that they needed for the business, right? A printer, paper, pens, ink, right? The office space. What about if they're paying employee salaries? The salary is now an expense and they get to deduct that, right? So you can quickly see how being a business owner, you get more incentives because you're allowed to write off more. Now, why is that? Because if I hire 2 W-2 employees, the government gets their paycheck or their taxes immediately by 2 people. right? So by me being a business owner, the government has incentivized me and said, thank you for making more jobs so the government can get paid more through taxes. You see? So it's a game of understanding that how do we optimize our tax incentives by literally doing what the government says, this is what I want you to do. These are the incentives, these are the rewards by doing X, Y, and Z. All right. And so ultimately, the game is to pay as little as possible in taxes. And this is a controversial topic because there are many wealthy people out there where the average American feels upset because they pay an absurdly low amount of taxes. The issue is, it's not that they pay low taxes. They're not doing tax fraud. They're not, cheating and lying. They're literally doing strategy and doing what the IRS code tells them they'll get rewarded for. That's it. So it is what it is. We're not going to get political on this at all, but you have to understand that the wealthy know this. The wealthy know money. So it's your duty to understand money and understand taxes. All right. So next is the tax strategies. So first and foremost, the tax deductions. This is pretty, it makes a lot of sense, right? It's pretty plain. This is the most known process, I would think, as far as reducing your taxable income, right? So directly reducing your taxable income by taking deductions or basically writing off your expenses. So just like I said before, as the business, let's say we had a gross income or revenue. Okay. So that means all the money coming in, from, say we did 10 wholesale deals, a couple flips, a couple sales, whatever. And we've made $100,000. All right, great. So let's go back to that tax bracket there. We made $100,000. We know we're over here in this fourth tier at 24% on a section of it. Well, now we got to figure out how can we write off more expenses through tax deductions. All right, well, I paid for marketing, right? I paid marketing. I had to get these leads. I paid $3,000 for marketing. I had to pay signs. I had to pay signs out, which could be another brand of marketing. I had to pay a bookkeeper to make sure my numbers were right. I had to pay a CPA, right, to actually file the taxes. I had to pay for printer, ink. I had to pay for internet to do my job. I have an in-home office space that I get to write off some of those expenses, right? I had to pay for gas to travel from site to site. I had to pay the construction, the renovations. I had to pay those. Those are expenses, right? And so you start to see how you can quickly add up these tax deductions. And let's say we made that $100,000 in raw revenue, but we took off $50,000 worth of expenses. That means we've now dropped from that fourth tier to that third tier, right? And so the tax deductions is the most simple way to get down to the next lowest tax bracket. And the game of taxes is, how do I get all the way to the bottom? How do I get to that 0 to 10% as efficiently as possible? Okay. All right. So that's tax deductions. Now let's talk about deduction rollover. In the same scenario where we're doing tax deductions, and let's say we made that $100,000 in revenue, but for some reason, we were able to write off or find expenses of $150,000, all right? At $150,000, what we've done was we've effectively decreased our taxable income to 0, and then we've shown a loss of another $50,000, right? Well, the IRS is going to sit back and look at it and say, okay. We'll allow you to take your full deduction, show no taxable income. That's fine. But that extra $50,000, do you think the IRS is actually going to pay you money to say, hey, you lost money? Here's here you go, just to help you out? Nah, right? Remember, the W-2 employees, when they're going back and they get a refund, it's because they've already paid, right? They've already overpaid, right? You're trying to get that refund back, right? With self-employed, if you get a refund back, it's because you've already paid a portion of it. The government isn't trying to just give you money just because you lost money. So keep that in mind. At the same time, they're not going to allow you to say, oh, you've lost $500,000 this year across the board, right? Your net taxable income is negative $500,000. They're not going to allow you to just take an absurd amount of loss on paper. Instead, what they'll do is they'll actually divide it up and into segments, right? And it could be 30,000, it could be 50,000. There's a few different tax filing styles that allow you to take a little bit more here and there. Get with your CPA for that one. But let's just say it's $30,000. So let's say we lost in that same scenario. We had 100,000. We've written off 150,000. So we only got 50,000 in losses. Well, they say, no, you can only take 30,000 this year. Show 30,000. Well, the beautiful thing is the IRS was not going to just throw away the other 20,000. The IRS decides, okay, we're going to roll this over into next calendar year. It never goes away. It never expires, right? So let's say the next calendar year, you already have that $20,000 that's going to fight against your taxable income. But let's say you write off another $50,000. Well, now you have a total of $70,000 in the negative. They'll only allow you to take 30. So you get to roll over $40,000 the next year, right? So just understanding how tax deductions in general work, and then understand that you will be capped, and then you can roll over the tax deductions because they don't expire. That's two strong methods for tax strategy and planning. All right. Next one is tax deferment. This essentially means you don't pay now, you pay later. One of the most common ones would be the 1031 exchange that most of you guys have heard. Essentially, when you sell a property in order to protect paying taxes on the capital gain, you're able to roll it into another like kind property. Now, the thing is, these taxes don't disappear. You don't get to not pay them. You're just waiting to pay them. And so in the game of deferment, it's how long can I defer them? And then at the end of that life cycle, when I know I have to pay, is there another tax incentive program I can kind of dump that money into to hedge it even further, right? And so that's the game there. And the reason I have traditional IRA on there is because it's very similar to that, where with the traditional IRA, you're putting in essentially pre-taxed money, non-taxed money. So when you're actually ready to withdraw it at 67 and a half, 70, whatever that number is, you have to pay taxes on the amount that you draw out, right? So in that same scenario, you are just deferring the taxes. The taxes don't go away they don't just disappear. All right. And then the last strategy is depreciation. Now, understand that depreciation, I think, is one of the most misunderstood strategies. So with depreciation, guys, you slowly get to apply deductions over a span of time. Now, every item you can think of that the IRS tax code has assigned a useful life for that item. And what that means is they believe that if you purchase the property today, you will be able to depreciate the value over the useful life, because at the end of that useful life, then it's pretty much, it's done. It's served its purpose. It served its value. You probably need something new anyway. Okay. To give you an idea of what that looks like is a home. Let's say you purchased a home for $100,000. What the IRS says is that you're able to take a residential property. A residential means a human lives there. So whether it's an apartment complex or a single family home duplex, it's residential. The IRS says you can take the purchase price and depreciate it over 27 and a half years. Now, that's an overgeneralized statement, but understand you can do 27 and a half years of essentially the value of that home. So in that same scenario, we'll take $100,000 and all we do is divide it by 27 and a half years. That means every year we can deduct $3,636 from our taxable income. Okay. So if we're at that $100,000 taxable income, we can now take off that $3,600 and be close to somewhere around the $96,000 in taxable income. Okay, right. So understanding that depreciation is a long-term play for sure, but it'll slowly depreciate, and it allows you to take it off year after year after year over the useful life. And now everything has a different useful life, right? So a car can be depreciated, right? A roof can be depreciated, right? Appliances can be depreciated. A lot of the times it needs to be a physical asset, like a true, something that's tangible, right? It can't typically be a service. It has to be a physical asset that you purchase. And the price point, the sweet spot, it has to be over that $2,500 mark for you to really depreciate it. Now, there are some cost segregation specialists that might be able to have certain loopholes and understand how to apply the depreciation differently, but that's a good general rule of thumb from the average day consumer, $2,500 purchase price, and then you'll be able to depreciate it if that makes sense, right? And so let's think about that real quick. If you have an item that's $3,000 and it has a depreciation life of 5 years, that's $600 a year that you can depreciate from your taxable income. Or you can elect, depending on the item, you can elect to take that $3,000 and just use it as a tax deduction, right? And so in that same scenario, if you had $100,000 in revenue and you chose the tax deduction, your taxable income then drops to $97,000. If you chose to depreciate, your taxable income will drop to $99,400, right? So understanding which one of those plays would actually help you get to that next lower bracket is part of tax strategy. All right, moving on. So let's talk about the pros and cons real quick. What are the pros? Obviously, the pros for paying less taxes is paying less taxes, right? You get to reduce taxes, you pay less. The next one is protect your cash flow. So this is super important. Remember how we said you have your tax deductions that come out immediately, and then you have your depreciation over a lifetime. Well, understand this about tax deductions. A tax deduction is almost equivalent to an expense, right? Meaning, if I made $100,000 and then I had $50,000 worth of tax deductions, that means I've actually paid somebody or something $50,000. So my taxable income of $50,000 is truly my income for that year because I actually paid out that $50,000. Whereas depreciation, you pay one time, right? You pay one time this year and you depreciate it over a lifetime. So in that same scenario where I made $100,000, but for some magical reason, I've had $50,000 worth of depreciation from an asset that I may have bought a year or two ago. What I've done was I've only been taxed on $50,000, but I get to retain that other $50,000 tax free because the depreciation reduced my taxable income. Does that make sense? So you see now that depreciation and tax strategy, you can protect your cash flow. And in the apartment game, they do this all the time. Cost segregation is a way where they depreciate not only the asset itself, but they depreciate the roofs, the appliances, the landscaping, all these items over different variation periods of useful life, right? Some are 3 years, 5 years, 7 years, 27 and a half years. And they cost segregate, so they depreciate it all at once. And so we accelerate depreciation. And so in that scenario, let's say you made $100,000 in rental profits, but you're able to take $100,000 in depreciation on year one. Well, hell, you just made $100,000 tax-free, right? So that's the beauty of understanding that. Now, the last pro there is exponential growth. Imagine that same scenario, $100,000 tax-free, and you turn around and put it into another investment and do the same damn thing. It's like magic, right? It's just because once you understand how to actually use that tax system to benefit you, that's how the game of wealth is actually played. All right, some of the cons. Really, it's only 2 cons, and I kind of broke it down into 4 little bullets there. But the first one is you are going to have a difficult time trying to secure a personal loan if you continue to show that all of your companies across the board continue to lose money, right? Or you only made $5,000 of taxable income. Now, when a lender looks at you, now a good lender should be able to add back depreciation, all that other good stuff. But when a lender looks at you, they're going to say, okay, this is, yeah, I don't know if we can trust, giving you our money because I don't know how you're going to pay us back. Right. So that's one of the cons. It's going to be a little bit more difficult. Not to say it's impossible. It's going to be a little bit more difficult. And the last one is there that truly, instead of focusing on accumulating more passive income, if you actually wanted to get a loan and be, considered lend worthy, then you would have to focus on active income, essentially making more money. Not a bad thing. Not a bad thing, but just understand that, okay, if we reduce our taxes all the way down here, if I still want to get out there and buy my beautiful home under my name and all this other stuff, that just means I got to go out and sell some more, right? It's a good motivation, right? But just understand that there's the pros and cons. I don't really like to call them cons, but it's just things to be aware of with reduced taxes. All right. So we're here, we're wrapping it up. So tax strategy is the game of the wealthy. Everybody does this. Don't hate the player, hate yourself for not knowing any better, right? Now, I know that's harsh. I know it's harsh, but you guys, you got to understand the wealthy have been taught this. Most of us have not. Whose responsibility is it for you to learn this and for your legacy, your next generation, your children, your grandchildren, whoever it is that you're around and motivating and mentoring? Whose responsibility is it that that community knows taxes, knows how to create and preserve wealth? It's your responsibility, okay? Warren Buffett is most notably known for saying that he pays less taxes than his secretary. Now he's worth 86 billion, 88 billion, fourth richest man in the world, something like that. And he pays less in taxes than his secretary. Now I got it. I'm sure his secretary is getting paid. I mean, she's Warren Buffett's secretary, right? But still, she ain't making billions. So how the hell does he do it? Taxes. All right. Next thing is you got to plan and strategize long-term. It's not just 1 year. You can't just say, hey, I'm filing my taxes for 2020. I'm just ready to get it done. I'm gonna go TurboTax and H&R Block. You can do that all you want, but literally every year you might just barely get a little something back, or you might get your per child stipend or something and be like, woo, I got 5,000 back. Remember, you've already paid that money. You've already paid it, right? A good tax strategy is being proactive, right? You're thinking, all right, if I want to retire at the age of 70 or 40, and I want to have $50,000 to $80,000 coming in every month, how much in taxes am I going to pay on that? Well, how can I reduce how much taxes I pay on that, today? What can I do to implement so by the time that time comes, I'm paying less taxes or no taxes on the money as it comes out, right? That is called proactive tax strategy. And the last thing is work with your CPA, guys. A true CPA is not just an employee. It is truly a business partner. They will be able to mentor you, guide you, and point you in the right direction, which is extremely powerful, because as your business changes, which it will, as your financial situation changes, which it absolutely will, a CPA will be able to tell you, okay, here we go for fast growth. Here we go for preservation. Here we go for estate planning and securing, right? And a CPA is just one piece of the puzzle. There's going to be some attorneys in there, potentially a financial advisor, potentially you're going to hire your own CFO. But understanding the basic concepts is going to be extremely important for tax strategy and planning with your CPA. So I don't know who wrote this, but I just thought it was funny. No matter how bad a child is, he's still good for a tax deduction. So if y'all got some kids out there that, maybe they giving you gray hairs, or you pulling your hair out and you're getting bald like me, hey, at least they're good for a tax deduction, right? Well, I hope you guys enjoyed the content. Obviously, if you're still listening, I really appreciate it. If you guys want to see more content like this, let me know. Drop it in the comments below. Of course, you guys got to give me a like or something. Share this to your friends, to your family, to somebody who needs to see this, right? Our new Military Cashflow website is up and running, or at least it will be very soon if it's not yet there. So be sure to go out there and check out all the new content, past videos, all that good stuff. And as always, guys, come join our Facebook group. We're there. We're growing. We're growing. We're growing. Till next time, this is Mike Glaspie signing off.